our investors invest in us to do secondary deals, and that's our focus. And other investors are investing in, in fund of funds or directly into the GP or into new pools of capital to make primary commitments. And I think you've got a very different risk-reward profile in those two types of transactions. So I think it's hard to say whether one is better than the other. I think the advantage, but having said that, I think the advantage of acquiring an LP interest when in a secondary market is you can already see the assets. You can evaluate the value of the assets without necessarily taking the risk of whether or not future investments are going to be put to work. The capital, is going to be put to work well. But predicating all of that, and this is in answer to your first question, it always comes down to the quality of the GP, the stability of the team, because ultimately that's going to drive both what the fresh capital is being invested in, but also what kind of assets have been invested in since up until that point where you are buying that interest. So, in a sense, it's not a question so much of making a primary commitment versus making a secondary acquisition. It's a question of, can you find the right teams? Are they good at making investments? Do they serve their LPs well, i.e. do they make distributions? Do they generate value for their LPs? And concurrently also generate value for themselves. So, I think, being a secondary investor, I would, maybe just to be biased, I would say doing secondary deals creates a better risk-reward profile. But having said that, I think, the secondary market compared to the primary market is so small that, you can't swim against the tide that much, right? In the sense that, well, frankly, you've got a lot of people putting money, primary money to work, so you can't second guess that.
Sure. So what is the kind of sense that you can give us, an on-the-ground sense of the quality of Indian GPs that you can see? Is it difficult to do deals in India? Is it easy to do deals in India? What is the sense?
The quality of GPs in India is the same as any other market, which is you've got good GPs and you've got bad GPs. India is not the only part of the world where you've got bad GPs. I think a lot of people will say that overall the Indian private equity market, as I mentioned earlier, has not performed to expectations. So you could say that on that basis, the balance is more skewed to kind of the lower end of the scale rather than the top end of the scale. But there are Indian GPs who are of the highest quality. And I think that's true, frankly, of any market. And I wouldn't characterize India as having any worse profile, I guess, of GPs. The one thing, though, that I think it's worth noting is that a phenomenon that happens in India more often than in other markets is the level of teams kind of splitting up and reforming, kind of branching out. It makes it very difficult to figure out as an LP, primary or secondary, whether or not the person that you're backing really has the right track record. It's a track record attribution issue. And I think that means that you just have to do your due diligence properly. At the end of the day, we are a GP ourselves. We've raised a fund, and it behooves us to do our due diligence properly. And it's not simply a matter of discounting heavily. It's you have to do your due diligence on the assets as well as on the GP, and nothing gets around that. It's just good, hard, diligence process.
Sure. And which are the 3 funds that you have commitments into? And I was just like, and what essentially do you look for before investing into any private equity fund? Yeah.
Generally speaking, we don't talk about the GPs that we specifically are invested in. Having said that, there is a transaction we are working on that in about, call it 2 months, we'll be able to disclose, and I think everybody will be able to see what that looks like, and I can be sure to let you guys know, because there are Indian assets in that portfolio, so they will be of specific interest to your audience. People of high integrity, of astute mind, and good sensibilities, and knowing that ultimately they're investing their LP's money.
But don't you think that this kind of instability that you have in the Indian market right now poses any kind of serious concern to you?
I wouldn't say it's a serious concern. Again, it's a concern that you just have to address with appropriate due diligence. So it behooves us, as I said, to the burden of responsibility of poor returns is both the GPs and the LPs, in the sense that, you know, LPs at the end of the day, they have, you know, if they invested in the wrong GP, that's kind of part and parcel with not having done the right work. So, you know, I think it's unfair to always put everything, I think, when something goes wrong in a fund, to always lay it onto the GP, at least in terms of the ultimate returns. So.
Can you just, you know, take us through this, how the secondaries market evolved in India, the private equity secondaries market, which actually is kind of a very recent phenomenon? I mean, the funds like yours becoming very active in the market, yeah?
Well, I think it's evolving. I don't think it has evolved fully. For certainly, you know, it's nowhere near as mature as the markets, the secondary markets in Europe or the US. And, you know, I think to the extent that, you know, a market is driven by the participants who are in the market. It doesn't exist and then the participants come in. You know, you have to create the market. You know, we took a decision at Paul Capital to specifically come out here to Asia and said, you know, there hasn't been much secondary activity in Asia in general, and also in India. But we think that if we create a presence here and fly the secondaries flag, we will find transactions and we will find deal flow. And if that generates more deal flow for other secondary investors, it just means that the market's getting bigger. So I'd like to think that we are, you know, Paul Capital is fundamental to the evolution of the secondaries market in Asia, you know, and in India specifically. And as you can see, you know, as I mentioned earlier, you know, with our appointment of our two regional representatives, Anand and Akshat, this is the first presence that we have in India of any kind. In Asia, outside of, you know, our Hong Kong office, which is where I'm based. And it goes to show how serious we are about the Indian market. I don't think opportunism is the word for it. You know, I think an investor is an investor, and the golden rule of investing is buy low, sell high. The golden bad rule of investing is buy high, sell low. So, you know, I don't think you can lay it on secondary investors specifically for coming in at the bottom of a cycle. In fact, I would question any GP who does not try to take advantage of a bottom of a cycle, whether that's secondary or, you know, a direct investor. I would certainly think that if I was making a primary commitment to a GP, I would want them to be buying at the bottom of the cycle and selling at the top of the cycle. So to me, I think there's a bit of a, you know, I guess a misconception of what role we play. And how we go about our business. If we only invested on an opportunistic basis, you would see that we would only be investing during downturns. And we consistently invest year over year, even through upturns and downturns.
How are the valuations now in the market? Significant premium or discount?
I would say that, you know, pricing has stabilized. You know, certainly pricing you know, went through a pretty deep trough during the financial crisis. And I would always be cautious to mark pricing as a discount, because it's a question of discount to what? You know, is it a discount to future value? Is it a discount to present value? You know, historic cost? So in a sense, the discount is really not the true measure of you know, of either the quality of the assets, the quality of the GP, or indeed a state of the, you know, it's not necessarily reflective of anything more than whether or not we are coming out of a cycle, out of a trough in terms of the economic cycles, where you have historic valuations being low and increasing, or indeed going into a trough where historic valuations have been high and you're going down, in which case, of course, the discount gets big. So to me, discount is only interesting to the extent that it helps you index the movement in valuations, but it's really nothing more than that. So I think it's a bit of a misperception that discounts get deep when there's a crisis, and discounts get small when there's, you know, it correlates very much with which part of the cycle that you're on. So I tend to stay away from commenting specifically about discounts or premia. I think we're in a stabler market. You know, certainly there was, you know, during the financial crisis, there was a pretty serious dislocation where there was, you know, high historic costs. You know, everybody recognizes the fact that during the bubble years, you know, there was a lot of liquidity. Liquidity was driving up price. And when that liquidity went away, then prices came down. So when you look at it on a historic cost basis, of course discounts were very deep. Acquisitions of LP interests in 2009, again based on historic cost, was going. Things were trading at 30 to 40 cents on the dollar.
Yeah, sure. And it's a difficult fundraising environment, and there are a lot of funds from India trying to raise money. So, and in times like these, funds like you become extremely important.
Well, it's creating more opportunities to have conversations that, in an otherwise, in frothy markets when there's lots of liquidity, when you're the one who has, it's easier to raise liquidity in a frothy market. And that's just the reality of it. And we are in an environment where liquidity is a lot tighter than it has been in the last 10 years. And naturally, what it means is that, alternate sources of capital such as ourselves are finding more opportunities. But, again, it's a demand and supply equation. And I think there's always an equilibrium. And, there is no free lunch. And, there's no such thing as a situation where we can necessarily kind of take the leverage that we have and exploit, you could almost say. We've been in this business for 20 years. In fact, this year is our 20th anniversary. And we're not, you don't stay in business for 20 years by taking advantage of situations. It's all about, agreeing to a fair price that meets the expectations of the seller, or in the case of, anyone who's looking for liquidity. And, at the same time delivering returns to our own investors. We have to deliver returns to our investors. We are a GP ourselves. So, I think it's a question of just finding the right balance and, having a long-term business that is sustainable. And, in our business, sustainability as a GP is to deliver returns. So it's we have to balance those two things.
Sure. Last question. How has India proven to be as a market for you in terms of return perspective? And, also what are the kind of finding trends that you've seen in private equity industry going forward?
The returns for us in India, I would say, as I think I mentioned earlier, have been very good. I think we've been very satisfied with the transactions that we've undertaken in India. The $50 million approximately that we have deployed in Indian assets. I would say that we're tracking very well against that deployment. So, we're very satisfied. And we continue to look for opportunity, and hence we're here, and hence we're, kind of adding to our team here. And it's all symptomatic, or it's all reflective of, a satisfaction with what we've done in the Indian market. Key 2 or 3 trends going forward in India. I think there will be, I think while the amount of capital that might be put against GPs going forward will stay, somewhat muted. I think that's a phenomenon globally, and I think India will be subject to that as much as any other market. Having said that, there's, I think, a specific nuance here, which is that you're now finding, GPs who are laying down track records, and I think you're going to see a differentiation between those GPs who perform and those GPs who have not performed. So I think that's one key thing. Is I think the market is just generally more mature, getting more mature, and you're going to see almost like a greater spread of GP quality, or at least their track record. So I think that's the first thing. I think the second thing is that, I think returns from Indian private equity will improve. And I think that's, again, I think that's fundamentally driven by, that's driven at the first instance by the fundamental macro picture of India, which I'm very positive about. That's the first thing. And I think the second thing is, again, as the market matures, you've got more experienced GPs who've taken their learnings from the past and know how to invest even better. So I think returns will improve. The final thing is, I think, from the secondaries perspective, we would, the Paul Capital view of India is that, we will see increased secondary activity. We look forward to being, a fundamental driver of that activity. And as I mentioned a little earlier, what we do is helping to define the market and helping to evolve the market. So all the things point positive, I think.
Thank you.